Real estate investment practice problem using OneNote. Loan amortization schedule worksheet with no tables. Get ready because it's time to raise the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, note that we're in the icon on the left-hand side. We're in the Practice Problems tab. We're in the 4010 Amortization Schedule Worksheet No Tables tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our practice problems will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. Note that we do work this problem in Excel and provide Excel worksheets that you can use to work through the practice problem and or use the worksheet for your own purposes. What we would like to do here is work through the problem with less Excel formatting so we can go through it a little bit more quickly and look at the objectives of it. Then you can determine whether or not you want to work through the practice problem in Excel and or use those Excel worksheets for your own purposes. So we have the information up top. We're going to assume the home value or the home price is going to be the $500,000. The down payment is going to be 20%. We're going to assume then the rate at the 5% and the years at 30. So given that information, the first thing that we would typically need to be calculating is the payment amount. That's going to be the general idea that what we would have. When you set this up in Excel, what you'd like to be able to do is set it up in such a way so that you can change these variables and have them automatically change the payment amount as well as the amortization table. Now, I want to point out at the start that you do have the online calculators that can do this as well, and I'm not promoting any particular online calculator, but here's just an example of one where you have similar data where you're going to say the loan amount, we'll say $400,000. We've got the 30 years, 5% rate, and if we calculate it monthly and calculate that, then it'll give us our data up top, which is going to be the amount that is financed, the monthly amounts, and it'll even give us our amortization table down below, which will break out the interest and principal. So that's pretty nice, and we do have some flexibility that we can then change the loan amount, the term, and the percent, and then we can see what the impact will be on the monthly basis as well as the amortization table. So these are going to be useful. I usually like using these as a double check instead of as a thing that I typically rely on, because if I want to customize any of the data, for example, break it out not by month but by year, I can't really do it as easily with this kind of calculator as I can do. I can do anything I want if I can do the same thing in Excel. So what I would typically want to do then as we construct our Excel worksheet is see if we can mirror and double check what is happening with the online calculators, and then go from there and customize what we're going to be doing in Excel, and we'll do that in multiple presentations going forward. So if we have this information, then what do we need in order to calculate the payment? Well, first we're going to need the loan amount. So if I have the home price at the $500,000 and 20% down, we could say, okay, well, how much will I have to put down then? $500,000 times 20%, $500,000 times 0.2 or 20%, giving us the $100,000. That means that the amount of the loan being 400, which would be 500,000 minus 100,000 would be 400,000, or we can take 1 minus 0.2, 100% minus 20%, 80% then of the price of the home, meaning if 20% is down, 100% minus 20% or 80% would be the amount financed times 500,000. That would give us our 400,000 down here as well. Now, the interest rate, also just realize that the interest rate is given in terms of yearly rates. We don't typically talk about interest rates in terms of monthly rates, even though we're going to be calculating them in monthly intervals. And so it would make sense to think about monthly rates to a degree, but there's a couple different reasons we don't do that. One reason is basically if I was to take this 0.05, 5% in decimal format, divided by 12, we would get the monthly rate, which in decimal format is quite small and difficult to communicate. In percentage format, it's still quite small. Moving the decimal 2 places over would be the 0.41666, and it's repeating. So typically we see the rate as a yearly rate when we do the amortization schedule. However, we might see it as a monthly rate. We'll see that shortly. Then We have the years. Now the years, we typically say the term of these loans are in years, even though they're really in periods of months, because we're going to be repaying in monthly periods. So in order to do our payment calculation, we need to know the number of periods, which will be in months. So if it's a 30-year standard 30-year loan, we take that times 12, because there's 12 months in a year, and we would get the 360. So we got the 360 months that we would have. Once we have that information, which we can basically populate from our basic information up top, then we can use our payment calculation. Once again, when we set this up, if we were to set this up in Excel, we want to do it in such a way that we can pull our data from our data up top, and therefore if we change the data up top to say a home price of $400, down payment something other than 10%, rate 4% or something, if we change these items up top, it will automatically change our payment amount. It will automatically change our amortization tables. That means when you set this thing up, you want to put references in. This is the general formula for Excel for a payment calculation. So a payment calculation will typically look like something like this. I put the negative up front of it, so equals negative. You don't have to put it up front. You might put it in the present value, which is probably more proper. But I like to put it up front. If you don't have any negative, it'll represent and show a negative number. And you typically want a positive number. The negative number then flips the sign. We have a PMT function, and then these are just the arguments of the function. You don't need to go past the present value, so no future value, no type, just these three arguments that will be involved. The rate stands for the rate. The number of periods is going to be the periods that will be involved, and the present value is the loan amount, because that's the amount currently present value of the loan at this point in time. It's a little bit more tricky though, because if I put the rate up top, remember I can't pick up the 5% here because that is going to be a yearly rate. The monthly rate is 5% divided by 12. It would be something like that. I'm not going to hard code in here 0.004111666 because one, it would be tedious to do so, and two, I want to reference the cell up top, so if I change this rate, it will change down here as well. So what we're going to do is reference that cell. That B7 is referencing that 5%, divide it by 12, and then Excel can handle that small number no problem. Then we're going to say comma. The number of periods is not going to be 30, but 30 times 12 or 360. Now, if we didn't put these months up top and we just wanted to keep the 30, we could take the 30, referencing that cell, times 12 to get to the 360. Or if we calculated this 360, we can simply reference the 360, not the 30. In other words, this rate and this number of periods have to be the same. The rate is always going to be monthly, and then the number of periods is always going to be monthly. And then you got to figure, well, is it a 30-year loan, which is kind of the standard oftentimes, or it could be 15 years, something like that. If it was 15 years, it would be 15 times 12 or 180. And then comma, the present value, you will recall, is the loan amount, not the home purchase amount, but we're talking loan at this point in time, which is the $400,000. It's referencing up to that $400,000, so we can pick that one up automatically. We don't need any future value argument or any type argument that'll populate automatically. That gives us then the 2001.4729. Note that this is a rounded number because it might not be even in this calculation, but we're going to round it to 2 pennies, so 2001.4729. So then once we have that information, we could calculate then the total payments and the total interest right away for the entire life of this thing by simply saying, well, if the payments are going to be the 2147.29 and there's 360 of them times 360, which is 30 times 12, that would mean that we're actually paying over 30 years $773,023. And we know that the actual loan amount is only $400,000. So if we take that amount minus the $400,000, that means that we would have the 373,023 about, it's rounded here, for the actual interest, the interest on it over the life of the loan over the 30-year time frame. So now this is going to be the data that we have up top. This data just populates automatically. We got the 500,000. If we change the 500,000 here and at the 20%, that'll change the down payment and that'll change the loan amount. So if we have any adjustments there, those will populate. The 30 years is the standard 30 years loan. If I change the 30 years, it'll change the months because this is just taking the 30 times 12, whatever in that cell times 12, and the rate's going to be the 5%. If we change any of this data up top, it will then change the payment amount. The payment amount mean one of the primary factors that we will use to build the amortization schedule. So now let's just take a look at how to build the amortization schedule. Now this is a long, tedious schedule because it has 360 periods to it, but it's actually really easy to do in Excel. So we'll just look at it conceptually now, how you would build it so we can understand it. And then if you want to build it in Excel, you can go over there and check out that practice. So one of the most difficult things about the amortization schedule is just setting up the headers. So the headers, what we're going to have here is I'm going to have the years on the left-hand side, and then we're going to have the months, which maybe should have an S, but months, and then the payment, and then the interest, the loan reduction, and the loan balance. So in other words, we're going to have periods. The main periods are going to be months because it's going to be in months. There's going to be 360 of them. But we also, of course, might want to have the years because the years are going to be useful for us to conceptualize it in terms of years. And if we want to build another schedule breaking out by year, then that would be useful. The payment amount is how much we're going to pay. The interest represents kind of like the rent on the money, meaning that it's kind of like renting an apartment or something like that. The rent is renting the use of the apartment. The interest is renting the use of the purchasing power of the money that you're basically paying. So if the payment is going to interest, then it's not going to the reduction in the loan amount. So the difference between the payment and the interest will be the loan reduction, and then the loan reduction will decrease the loan balance. So let's see a couple of these things. But before we do, let's just look at the payment periods here. A little bit tricky to get the payment periods. To do this in Excel, very easy to just populate the months because you could just basically say 1, 2, and then use autofill, which can detect the series to then calculate the rest of the months. It's a little bit more difficult to populate the years over here. So notice how we're populating the years. We're saying I want everything within year 1 to have a 1 next to it, and then year 2 start down on the 13th monthly payment. Now you might say, hey, look, I only need a 1 here, and then possibly a 2 starting on period 13. That could work quite well once you populate it, but there's a couple problems for it. If you were to build a table from this later on, you really want to populate each of the fields, meaning if you were to make a pivot table from it, which we'll do in future presentations, you would like to populate each field so they can use that to pivot on. Also, just to do this logistically in Excel, to put these 1s and 2s there, it's a little bit easier to use a formula to put those in place. We'll do it's a little tricky formula to basically put that in place. So just note that that might be something worth looking at the practice problem for. We won't go into it in detail here. So then we got the loan amount. This is how you calculate it. You'd say, well, the payments are going to be the 2147. So that's going to be the 2147. It's rounded down here, so it's a little bit different. It's rounded. The interest per period would be calculated. You can do it one of or a couple different ways. You could say, well, the 400,000 is the amount of the prior loan balance times 0.05. That would be the interest if it was out for a year, which would be 20,000. But these are monthly amounts, so we're going to take that and divide it by 12. That would give us the interest of 1667. So therefore, if we're paying 2147 minus the amount of interest, the rent that's going to go away, the 1667, the loan is only going to go down by the 481, only going down by the 481. So therefore, the 400,000 minus the 481 is the new loan balance of the 399,519. If we did that again, same payment, 2147, the interest slightly different, now being 400,000 times 0.05. That's going to give us the 20,000 if it was for a year, divided by 12. That's going to give us the 1666 about, it's rounded. So if I have the 2147 minus the 1665, let's say, we've got about 483. Prior balance is going to be the 399,519 minus the 483. That's going to give us our 399,037. Also note that you could also calculate it this way, and it's useful to be able to see it both ways. You could say, well, the interest rate is 0.05, 5%. If I divide that by 12, we get a monthly rate, which is about 0.004166. which in other words in percent would be 0.41666 on forever percent. Taking that times the 399,399,519 gives us the 1665 about once again. So there's a couple different ways that you could calculate that. Now, if you did that all the way down for 360 periods, you should get 0 at the bottom of it. We'll scroll down as we do so. Notice the payments are remaining the same. Notice that the interest is going to be going down, and the loan balance then is going to be going up, as we've seen in prior presentations. So there's going to be an impact then in the interest and principal breakout, which could have an impact on other things, such as your refinancing later, your options basically at a later point in time, your loan balance at a later point in time, as well as tax implications at a later point in time. So we're down to 15 years at this point, and we're looking at 17 years, 18 years, and let's bring it on down to the 30 year, which we should finally be at 0 at the 360 months, 30 years. The payment is the same, the interest much smaller, much bigger amount of principal. We then have our totals down below. If I was to total up all the payments, same. We got the 773,023, which should equal, I'm going to scroll all the way back up. These calculations we came up to up top, 773,023. Interest is at the 373,023 on the interest. So scrolling back down, so there we have that just as our check figures. Now again, this is stuff that you could basically see that we've reconstructed what we could see in the online calculator. So this is our online calculator. We've reconstructed basically the amortization table, which is useful, but now we can basically customize this a little bit more on Excel, meaning, for example, what if we wanted to see this in terms of not by 360 periods, but on a year-by-year period, we can customize the table and make it look something like this. I want to see the sum of the totals in terms of 30 years instead of 360 and see the sum. So we might want the total payments that have happened for that time period, which would look something like this, which of course would be the 25,767 all the way down, because we'd have the same number of 12 payments, the payments being the same for all monthly payments. So it would just be the monthly payment times 12. The interest, however, would vary. So the interest would vary at the it would vary here. So the interest from a year-by-year basis, in year 1, we're paying 19,866, and of course it goes down. So if you're talking about year 15, 13,901, and year 30, we're at the 685. Now that could have a significant tax impact if the interest is going to be deductible. We're also going to have a difference in the loan balance reduction. So we can see the loan reduction is going to be going down at an increasing rate, resulting in the ending balances, these being the balances at the end of each of the loan periods, which might be useful because you might think about what would happen if you were to sell the home for a particular amount at any point in time, which you would take the sales price minus, the sales price, and then be taking into consideration how much the loan would be right at that point in time when you're thinking about how you'd have to be paying off the loan. Now, this kind of table to construct this is a little bit more difficult if you don't use fancy tables. In other words, if we used our amortization table up here and we were to build it or make it into, say, a pivot table or just a standard kind of table instead of an array or whatever, then you can use slicers to kind of break out on a year-by-year basis, and you could use pivot tables. But many people are intimidated by pivot tables. So in our practice problem, we'll have another method to kind of break this out without using pivot tables, and you can still get this added detail in there. And then in future presentations, we'll add the pivot tables and show how you can use pivot tables and slicers to basically get this added information, and or just use the worksheets that we put together and take a look at the slicers and pivot tables for your own needs and purposes.